Welcome to another AVID chat. David Harple and my co-host, Jack Arnold. Good to see you, buddy.
Good to see you, Dave.
Today, we're going to talk quickly on two types of life insurance and when you should use them. I think everybody has heard the terms, no pun intended, term insurance and permanent insurance. And I would say the simplest, shortest analogy that I can think of using is renting versus owning. If you're renting somewhere, your typical lease is tied to a specific period of time, 12 months, 2 years, 3 years, etc. That's essentially term insurance. You buy it for a specific period of time. Once the term's over, that period of time's over, no more insurance. Permanent, like owning a home, is once you buy the home, you have it forever unless something happens and you stop making the mortgage payments or you sell it. That's permanent insurance. So two types, pretty basic. When we use them is a whole nother discussion.
Yeah. To your point, that's a pretty good analogy as far as how they work. Basically with any kind of insurance, one is to think like, what am I even purchasing insurance for? I think a lot of times, most of our interaction with insurance is like car insurance. A lot of times it's health insurance, and health insurance in my mind just it's not even really insurance. It's kind of a prepayment plan for medical services. Because insurance, what you really want to be doing is kind of offloading risk to a third party and paying them to take on that risk. You're basically pooling your risk with lots of other people. What you're offloading is something that's somewhat low probability, but if it was to happen, it'd be devastating. So
right.
You die tomorrow and you've got kids and a family and your income is gone. What do? That would be pretty catastrophic. Unlikely, but catastrophic if it was to happen.
It could happen, for sure.
Right. So if let's say you're 40 years old, the chances of you dying in the next 20 years, let's say, it's probably pretty slim. I mean, it's a low probability, not out of the ordinary and not, without chance, but it's probably low priority. You can get a good amount of insurance for that particular space of time, the next 20 years, when you would really need it, pretty inexpensively for most people. Obviously, it depends on your health. Lots of things that come into play. But that'd be a specific amount of space of time. When you buy something like permanent, you're basically saying, I'm going to buy it today and it's going to be with me the rest of my life. The problem is you're going to die. So you are actually insuring something that's definitely going to happen. So you're more prepaying for an inevitability than you are necessarily buying insurance. And the closer you get to that inevitability, the older and older you get, the more expensive that quote unquote insurance becomes. So there are some kind of tax benefits to life insurance. Death benefits mostly is that they come to you tax-free. And there's all kinds of things that go into it. I don't know if anybody actually has heard term versus permanent, but everybody's probably been sold some kind of, or pitched some kind of whole life or universal, all these different versions of permanent insurance. And there are things that you can use that, but for most people, it ends up being overkill and you don't really need it. You can come into, you're doing estate planning, things like that. But most people, you just need some term insurance because the risk is that you die tomorrow and you have people that are relying on you and your income, and now you're gone and you've lost all that income. That's the risk. Not that you're going to die when you're 80, because yes, you're going to die at some point in the future. Hopefully by then you have plenty of assets built up and kids are grown and everybody's taken care of. So
exactly,
mostly the time that you want to use it. If you're younger, you have people that are relying on you, you probably want to get some kind of term. It's inexpensive. You can get quite a bit. When you get older and you start doing estate planning stuff, maybe sometimes you want to include some kind of permanent insurance. But if you're 20s, 30s, 40s, the chances that you need permanent insurance is probably pretty slim. And it would be very, 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 very thin slice of people that would actually be beneficial to use some kind of permanent insurance.
Exactly. And if you think about just from like a building wealth standpoint, if I'm 40 years old and I'm building wealth and saving, my need for additional resources should be reduced because I'm saving, I'm building the wealth, I'm reducing debt. My kids are getting older, so they're less likely to need my dependents, et cetera, et cetera. That doesn't mean permanent insurance, whether it's whole life indexed, ULs, VULs, there's all sorts of them out there. It can't play a role, but typically we see that it's less and less until you get really, like you said earlier, more to like some, technical estate planning cases like that. So
right. Yeah, exactly.
Perfect. Well, if you have any questions, reach out to us. Click the link below to subscribe. We'll keep you updated on things like this on a weekly basis. For Jack Arnold, I'm David Harpole at AVID Chat. Thanks for joining us.
See ya.